You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
Good morning, everyone, and thank you, Andy, for your always enlightening presentation. I'd like to welcome John Lothian, our moderator, along with our esteemed exchange leaders, to the ever-popular Exchange Leaders panel. Thank you.
Well, hello. Good morning. Will all those who were alive during the 1960s please raise their hand? We actually have kind of a 1970s thing going on this morning. It's called 8 is Enough. We also have, if you'll notice, a problem with blue. And
they always wanted uniformity, John.
I know. The harmonization thing has just really gotten out of hand here. So wow. So Andy, I told yesterday that the headline of my newsletter was going to be "Tab Group puts a dark cloud over options industry," after getting a preview of his presentation. So there's some arrows that are pointing down. There's some troubled waters there a little bit. What are we going to do to turn around some of the issues that Andy talked about? Who wants to take the first shot?
Listen, I think the big issue that Andy focused on was the state of the markets in general, market conditions, and as exchange management, we can do a lot of things to modify market structure, bring new products to the market, educate people, but probably the biggest factor that makes us all look smart or not so smart is market conditions, which is what drives volume. And I thought Andy was spot on with his observations about this incessant bull market, which, from an investor standpoint is a wonderful, wonderful thing. And all of our 401ks look better. It's just that our companies aren't doing quite as well as we'd like because the market conditions don't lend themselves to a lot of trading. So, or hedging and what have you. People are buying the dips instead of hedging the tails. So if we've been in the business long enough, and Lord knows that I have been, we know that those things change.
Well, a couple interesting things that were in there that jumped out at me. He highlighted the OTC markets are winning while the listed markets are weak. Right, that shows on one hand, all right, what are we doing? What can we do differently? The flip side is that's the opportunity for next year and the following year, and the opportunity for us to continue to innovate and bring that stuff to the regulated markets.
Yeah, I think a big area that and Andy pointed to it, all the problems he associated with it all tie back to lack of liquidity in a lot of ways, which is the market maker community. This really, as we have this changing market, has highlighted how fragile the options market is, and that we're in a order-driven market. We're a quote-driven market, not an order-driven market. And without those market maker quotes on the screen, or weaker market maker quotes, or wider, whatever, however you want to deem it, that's the issue we're facing.
Are we killing the golden goose that is a quote-driven market with the move towards more and more auctions? Are quotes becoming irrelevant to the point that it's really going to harm liquidity?
I think that's definitely a big part of the issue. And just to echo what Ed just said, both Eds, one of the slides that Andy showed talked about the number one reason being institutional feedback that says there's really not enough liquidity. Also goes as far as saying that even so many years after the financial crisis, the big banks aren't really committing capital, even though I would say that from our perspective, we've seen that has come back somewhat. But there's definitely not as much of an incentive for market makers to quote. I think auctions are a really big part of it. I think that the continuing feedback we hear from, I think, all the market makers is that as exchanges, as regulators, there's really not enough in the market structure today that really incentivizes a lot of active, tight, liquid quoting. And I think that's something that we should continue to look at and see if we can come together and figure out how to fix.
Yeah, I mean, this has probably been the conversation that most of us in this room have had the most over the last, certainly the last couple of days of this conference, but obviously it's been an apparent and growing problem for longer than that. And I don't think there's any easy answers, and I don't think there's a quick fix or a silver bullet, unfortunately, either. But a number of the issues that we've touched on, there's some institutional considerations that are making it more difficult for certain entities, particularly banking entities, to be in the market-making business. There are concerns about the Volcker rule, which has a market-making exemption, but you've got to avail yourselves of that exemption in a very data-driven way in order to draw a bright line around liquidity provision versus prop trading. And as we all know, there's ways to be a market maker, but use that as a means to put on a proprietary position. And there's ways to be a market maker very legitimately and doing nothing but providing liquidity. So the need to distinguish those two things is one factor. The cost of capital is another. With a small number of firms clearing market maker business, and is there concerns about risk have increased as the opportunities to put that capital to work in other ways, perhaps that are under less of a regulatory microscope, have increased. The availability of capital for market makers looking to provide liquidity and clear options trades is not what it was. And then there are the market structure and institutional or exchange-driven considerations, like this long-term secular shift that we've seen over the last 5 years and beyond from an internalization model for consolidators and order flow providers that's preferencing driven, where I'm going to direct my order to an exchange where I'm a market maker on the lit quote so I can receive some preferential entitlement, like a 40% entitlement through a preferencing, or what we call in our markets a directed order mechanism, to the auction-driven mechanism where, in many cases, there's no incentive to be on the lit market at all. I can jump up in the auction and interact with the order. And if I'm the initiating firm, still receive an entitlement. So I think there are a number of factors that are playing together, and Boris is exactly right. In that environment, for us as exchanges thinking about options market structure and working with the firms and market makers and order flow providers represented here at the conference, it's very important to us to kind of rethink market maker incentives and make sure that all the pieces are in place to continue to encourage lit quotes on the screen, which are our best advertisement ultimately to our end customers as an industry.
Let me just take a little different angle. I agree with what these guys are saying, but if you look at kind of contrast and compare with the equity markets versus the option markets, the options markets, we have a very limited number of options market makers compared with the participants in in our equity exchanges. So that's one factor. I think another factor is the amount of product that an options market maker's got to make a market in and put capital at risk is much greater in options. So you got less trying to do more. We've got more exchanges. They've got to provide liquidity on multiple exchanges, which then begins to squeeze them. And on the other hand, we're always trying to do what the customers want and need, and they're demanding EQ. So we build these mechanisms which are very similar to what would be compared to like a dark pool and a TRF in the equity space, right? That is transformed into these auctions on the options exchanges, and I think we're providing a great service to the customers. But my fear is that we're going to continue to put pressure on the market makers, and not going to be able to make the markets a quality market in the products outside the top 100 very liquid names. And I think as a retail customer, you're looking at the screens, and if you see those quotes widening, you see a 3 at 350 bid and offer. They're not going to be that interested to trade that. It's not. I don't think that's the mindset of a retail trader, because a lot of those trades then go into the auction. So I think I look at it kind of broken down in those ways, equities versus options. We need to do something. 3 years ago, this is the last time I'll say it on this panel, when we went down because we wanted to compete with these auctions. I went to the SE, I talked to them about what could happen with this. It really has played out that way. There's less incentive to be on the market. I think it's a bad market structure. It's nowhere near as bad as the equity market structure, and I think we just need to kind of pull it back in and do something to make sure we still have liquidity on the screen.
I think we have to be real careful. You think about the question of auctions and spreads, right, and what that means for market quality. While there's clearly correlation between more volume being done in the auctions and the spreads being wider, I think it's tougher to point to the causation. Because if the spreads are wider and the spreads are wider for other reasons, then the auctions are that much more valuable and it's that much more important and it's that much easier to achieve that execution quality, and there's more incentive and more reason to do the auctions. Which way does that happen? So certainly the two things are self-reinforcing, but it's tough to say that the auctions are really what has driven the quotes to where they're at.
No, I don't think anybody doubts that the bid-ask spreads are wider because of the number of auctions and less incentive to compete. I think one of the things that we've all said is our best form of advertising is that market that's on the screen. Right. That market that's on the screen statistically has been shown is wider than it was in the past, and I think that is because, I think Tom pointed out, the flow is coming in directed toward a particular market participant. It'll be traded in an auction, and what you have on the screen pre-existing to the order coming in is not that relevant to whether you trade against it. It's how you react in the auction. So I think as an industry, having wider bid-ask spreads, while it may not impact market quality in terms of the actual execution, it's not a good thing for the industry, and I think it's something that collectively maybe we need to address.
One of the things that we've talked to our participants about, and we're not sure that there's necessarily a complete agreement, is the fact that it's not so much there's all these auctions and so the markets are wider. What is it really about the auctions? What is it about how they go up? And after the penny pilot began, everybody loves the penny pilot, back 8 years ago, one of the things that we did to fight against the maker-taker fee structure that we eventually obviously joined, and as did everybody else, was we argued that price improvement auctions ought to be allowed at the NBBO, whereas most of us will recall that the way they started required the PIPs, the PIMs, the AIMs to start a penny better. That, in our opinion, has had a lot to do with what we're seeing in terms of market quality. The idea that you can quote as tight as you want or can based on the fees, based on your trading interest. You could be on one of 12 exchanges, but an auction can start at your price. You don't actually have to be cleared out of the way. That's not to say that a lot of auctions, and in fact a great deal of auctions, takes place between the markets. I think that's one of the reasons you hear that the quality of execution and the actual realized market probably hasn't really widened significantly. It's really what people see on the screen. One of the things that we would want to see isn't something that any one of us can do unilaterally, and that is go back to
3 exchanges.
A structure where
eighths and quarters.
That's one option. But the other is to start auctions, require them to start a penny better. And as much as we all don't necessarily love pilots, we just had the SEC approve the tick size pilot on the equity side. It wouldn't be outrageous to see what could be done on the option side with a group of names, just to see what would happen to the market quality in a set of names. I think the one big requirement is that it would have to be done across all options exchanges.
There's also an underlying thing going on here that the market makers at the same time, while they can, there's a lot to be said about auctions and everything else, and that's what as things go up at NBBO, but market makers need to be incented to, in fact, be able to quote better. It's so that barriers to entry have gotten higher. We have less market makers in the marketplace today. They've got a lot more risk on the screen, as Tom pointed out. We've got a lot more strikes. We've got a lot more fragmentation, and that needs to be addressed. Market makers cannot afford to put a quote on 10 or 12 exchanges continuously in 500,000 or 600,000 series all day long, and have us expect them to have tight spreads. They need and we're all working on risk mitigation things and products like that. But at the same time, market makers need to have the ability to manage their risk well, or no matter what we're doing, they cannot be profitable. And at the end of the day, the market makers are the ones who support the business.
I just want to make one more point, and then I'll let Shelly talk. We're trying to. It's like in an equity dark pool. If you know who's coming through the front door to make a market to them, you can control your liquidity, and you can make a better market. That no different than probably standing in a crowd broker brings an order in. Yep. I liken these auctions to that, though, because you don't have to make a market. You wait, see what comes in, and if you want to put your price in there, you do it. So why, if we're doing 25% of the volume in those things, why put all the technology in to make markets and manage risk on a million strikes?
I couldn't agree with you more. I think that auctions are more of the result than the cause, but auctions certainly contribute to it.
So Boris, you're fined $1 for using the words penny pilot in an answer.
You're welcome.
Okay. So my concern here is what you're echoing around is that we've added a complexity to the option market that is making us look more like the equities market and the complexity there and all of the problems there, and that has negative ramifications for how the public is viewing the markets and participating. Have we become too complex?
Well, the option product is much more complex. People were throwing around the number of series. At CBO, we quote 855,000 series, so everybody's pretty close to that. We have a few prop products, but it's the number of series that we quote, the nature of the option product being as fragmented as it is, complex orders, these auctions. The market structure within the exchanges is complex, but I think it's still better than what we have in the equities world where you have so much trading in the dark. We can critique our own market structures and say maybe the options market can be better, but the fact that it's all traded on the exchange, to me, will still give us a great advantage over the equities market where so much trades away from the exchanges, in particular the retail flow, which adds so much liquidity to the operations of the market.
Yeah, a couple quick points. We have a dark market, though. That's that OTC market, right? Well, that is out there that we're not seeing on the screen. And then the other thing, that the question is compare and contrast to the equities market. That's a loaded question. We've certainly been talking a lot over the last year about the equities market and equities market structure. Hearing on the news, it's rigged, it's bad, it's in the spotlight. But really, if you look at the equities market, it's one of the best, most efficient, tightest, most liquid, well-functioning markets that are out there. So the fact that there may be some parallels and things in the options markets are like the equities markets, absolutely. We have differences, and it's important to take into account those differences. The equities market isn't a bad thing.
No, listen, I think we would all agree that the functioning of the U.S. securities markets are second to none. I think we can all self-critique our micro-market structure and come up with possibly better ways to do it. But nobody's suggesting, I don't think, on this panel that anything's terribly broken. I think that we're all very proud of what has developed over the years. But yes, John, it's very complicated.
Well, and the track record of the options markets has obviously over many, many years has been good, although we are down. I think Andy's number was 9% overall in equity options, carving out some of the index and other proprietary products. I think the number's about 7%, which is the biggest year-over-year decline we've had in memory, I think, except for 2012, which was on the back of an outstanding year in 2011 and it was still a record otherwise. I will say, by the way, we were watching Andy's presentation from the back, and so we were looking at the back side of that screen, and the trend line looked great when you look at it backwards. But to the point that both Jeromee and I think initially Boris made, certainly the equities market structure overall has resulted in a very attractive market by a lot of standards, but there have been some challenges. They've been increasingly acknowledged over the past couple of years, and we've seen now a concerted effort by the SEC in consultation with the industry to put forward a very different and interesting market structure pilot, right? The TIC pilot, which was just announced, some of the details were announced yesterday in final form. It's going to be a 2-year pilot starting about a year from now, dividing smaller public company stocks into various buckets with some data-driven approach down the road that would lead to some market structure decisions. And I think Boris is right. And there hasn't been anything like that in the options market, but I think taking a look at collectively what the incentives are, how auctions are functioning, what the impact of the auction functioning is on market maker incentives in auctions, again, in a data-driven way, would be a very interesting thing to do. And the elephant in the room, obviously, is we're all sitting here as competitors, but we all, to some extent, with respect to this conversation, have some degree of adverse incentives, because we're all concerned, I think, about market maker incentives, but at the same time, it's order flow providers who are bringing volume to exchanges. And to the extent that order flow providers have an affiliated market maker who want to touch their own flow, providing an auction or other mechanism to provide for a higher likely rate of internalization is attractive and wins volume to exchanges. Boris is absolutely right in raising the point about auctions starting at the NBBO. We have an auction mechanism that does not allow auctions to start at the NBBO below 50 contracts. We're not part of the pilots and other programs that some exchanges have put forward. In a sense, we philosophically feel great about that. Okay, so if you want to trade on the NBBO against a small order, you've got to be on the quoted market. On the flip side, all of our clients, many of whom are affiliated with large market makers that have an interest in, again, market maker incentives, tell us, by the way, I just don't send you my auctions when they're smaller than 50 contracts because I want to be able to start them on the NBBO.
Steve raises a good point that while we're all up here as competitors, and but we're all in the same game of needing volume, we're also all competing for the flows, so we do things that can be adverse to the marketplace. Another good example is, you mentioned your auction doesn't start at NBBO, but it has a harder time getting volume. It's maybe the altruistic thing to do, but it doesn't work from a business sense. The same thing goes with complex orders. Complex orders are allowed to trade through NBBO at almost all exchanges. We put a methodology in place to say we're going to protect them to trade at NBBO. Guess what? We don't do very much volume. It's altruistic. It doesn't work well from a business sense. So in many ways, we fight each other and take market structure in the wrong direction. And without support from the user community to support the, call it good actors from bad actors, that won't change because it is, in fact, competition.
Yeah.
I think, for the complex auctions, just so I'm not called a hypocrite someday, I think that's a different animal. It's not a quoted market.
Agreed.
So I think that, the fact that you can have those operate different than the way the other auctions work, I think is...
I totally agree with you. Just even though a complex order coming into the marketplace can trade through NBBO, it just seems...
Push, Shelly.
Yeah.
All right. So, Shelly, I want to ask you a question. You chose a checked color jacket, blue jacket. Everybody else very harmonized with a solid color. Harmonization of clearly this is an obvious error on your part.
Nice. It should be the worst one.
Well done. Do you have a problem with obvious error harmonization?
No, I don't. Actually, I think it's a great thing. It's one of the things we've worked together with as exchanges, and we appreciate the effort Bats has put out leading the charge. I think it's very positive for the industry. The worst thing that can happen for us as exchanges and our liquidity providers and the retail public is to have uncertainty. And when you have a significant market event and you don't know if trades are going to be busted or adjusted, what do you do with your hedge? One of the reasons I think we've seen a loss of liquidity since the flash crash is so many people stepped in front of a train effectively when the market was on its way down and had trades busted and had winners turned into losers, and just that overall uncertainty, very bad for the marketplace.
So quick update for the folks who haven't followed it as closely, and credit to everybody up here and everybody behind the scenes who helped with that effort. We do go live Friday across all exchanges with the new rules, the harmonized obvious error. So that is coming to tomorrow with the new rules effect across all the exchanges. Equally important to remember that there's a second half of that is still to come, right? So while we're all very much more aligned with the rules and regs as far as how we're going to handle those issues, that we still need to continue to do the work in preventing them from getting on the tape to begin with. So still more work to be done.
Back to your original topic, if I may, because Tom wouldn't let me get a word in edgewise. Another headwind we have as an exchange that impacts the liquidity providers and the exchanges is the regulatory risk environment. There's a lot of pressure from the clearing firms, the clearing corporation, to add risk controls. Again, we applaud their efforts. We think it's the right thing to do, but it's adding additional cost and pressure in the industry, and Reg SCI pressures as well, adding additional costs, causing the exchanges to have to focus very much on meeting the demands of Reg SCI. It takes away from our ability to continue to innovate, and it is a tremendous burden on the industry.
Is Reg SCI just another excuse for the regulators to fine exchanges? Like, you guys got to get it really right this time. You can't have an error. If you get an error, guess what? It's another $100,000.
You know, John, it's like a lot of government regulation. It starts out as a very well-intentioned effort on the part of the government to ensure that the exchanges continually operate, the clearing functions operate, the systems for disseminating quotes and trades are always operating. And they proposed those rules a couple of years back, and while the industry pushed back, as typically it does, believing they might have been overreaching, unfortunately, the industry then had a couple of hiccups in various ways and lent credence to the fact that those rules might make sense, at least to some degree. So those will be coming into place effective in November, and the industry, as an industry, and then the individual exchanges are undertaking all kinds of efforts internally to ensure that we are compliant with those by the end of November. And while they don't directly apply to the broker-dealer community, the fact is that they're obviously impacted by it because as we set up backup systems, as we use some of the broker-dealers for intermarket order routing, they find themselves, or they become vendors of ours and find themselves subject to some of the requirements really that we find ourselves subject to. At the end of it all, I'd like to think, and I hope this is the case, that the industry will operate in a smoother. And in fact, obvious error, I believe, was one of the byproducts out of the Chair White meeting 18 months ago. So there's lots of safeguards that are being incorporated in at all the exchanges in a somewhat standardized fashion and at the OCC to ensure that we minimize those kinds of disruptions in the future.
I think Ed validated kind of an axiom that I have, which is whenever there's a piece of regulation that is important but that we don't particularly like, we always have to describe it as well-intentioned. But it's true. The goals are obviously goals that we share. We should have efficiently functioning and smoothly functioning markets that provide a good experience for investors, and obviously stability is really, really important given the systemic importance of the U.S. financial system, and securities markets are particular. So absolutely, we of course support the goals of the regulation, but to be honest, it's complex. There are some aspects of the regulation as written that are unclear, and so we're all both separately and jointly as exchanges and SROs going through the mechanics of trying to figure it out and working closely with the SEC, ensuring that their expectations and our views of the regulation are well aligned. And it's a process, and certainly it will have some side effects. In addition to many, many good outcomes that will result from the regulation, it will increase challenges for our vendors, for broker-dealers who act as linkage providers between exchanges. Will have additional problems to solve. We're going to be watching them much more closely as markets and ensuring that they meet the standards that we're being held to. One of the very prudent aspects of Reg SCI was a requirement that exchanges can't get off the hook by outsourcing some critical SCI function to a non-SCI entity. So we can't just say, oh, this is a complicated problem, we're an SCI entity, we're going to have a bar up here to solve it, so why don't we give it to a non-SCI entity whose bar is only here and they're not going to be looked at by the SEC. It doesn't work. And that obviously is the right way to structure the regulation, but it can result in some of our obligations being transferred to others that we do business with, and they may not always like having those obligations transferred to them. So it's a long process. We're working through it. The outcome, I think a couple years after the fact, will be one where we'll all look back and say, this was really successful and we're really glad we did this, but it's not an easy process in the meantime.
I think at the end of the day, though, it's not going to change the way you develop systems and run markets. It's process oriented. It's going to be time consuming. It's going to be expensive, but there's nothing there that says, oh boy, yeah, I wish we would do that to protect, the way we build systems and implement systems. I think a lot of us.
I thought when Steve mentioned good ideas that turn into unintended consequences, he was going to bring up Penny Pilot again.
No, John would find me $1.
We'll leave Penny Pilot alone.
That's $1 to you too, Ed.
The big, I think, problem, or one of the problems with SCI that a lot of people are trying to understand is it doesn't define well how far you have to go. Ed had mentioned the effect on vendors, and as you guys did, how far do you have to go with your vendors? If you do bring in a vendor to run a system, do you have to know how their hardware is supplied? Do you have to know how the chip maker that makes the chips for that hardware is supplied? How far down the pipe do you go? And that hasn't been defined in it, and I think that's something that maybe we will clarify in the future, or maybe we'll clarify when there's an event of some kind, and that's often what happens.
So I want to talk to you about an event that did happen, which was the flash crash, which we've had some news of recently. Quite personally, I am very embarrassed with the information that came out from the futures world that there's this trader who was 29% of the E-mini market, on that day, and now he's been charged with spoofing and market manipulation and all, and that wasn't even on the radar of our regulators. We had a task force from the CFTC and the SEC looking at this, and they kind of just excluded that part of it. Bill Brodsky has come out and said, hey, we need to include futures data as part of the consolidated audit trail, which I think is kind of a pipe dream that will never, ever happen because it's too complex. But I do have another solution for when we have these events, and that is to take all that data that's from those events and make it part of the public domain, to give it to the crowd to look at and to analyze. Because I think we would have come up with an answer much sooner, and we wouldn't have had to pay some professor $600 an hour to look at it, because somebody would be incentivized to go find these problems. So what do you think about taking data from a market event like that, putting it in the public domain, and letting the crowd?
Let's go to what we're having to deal with, John, which is CAT. So we have no choice. CAT is on its way to becoming a reality almost 3 years after the effort became, and it won't, in fact, be a real thing for a few years to come. To Bill's op-ed piece, which had a terrible title on it, the SEC flubs, that was not the intent of the article. The intent of the article, which is something that he and the CBOE have been preaching for years since the CAT idea came up, is that these are integrated markets, and those products on the futures side, and your roots are the futures,
right.
They've got a hell of a big business in equity-related futures contracts and options on futures. So if you're going to have a CAT, and there's no getting around it, how can you proceed down that path without incorporating those products in which we interact with all the time? Then this case comes along, whether it has legs or not, suggesting that this character in London manipulated the market. Now, I don't know if that's true, but again, it proves the point that these are integrated markets, and if we're going to do CAT, and I think we have no choice on that, you must include those products. As to putting all the information out in the private sector and letting academics and other interested party have access to it, you'd be relying on the motivations of that group to find problems, which I think as a regulated industry, we have the obligation to seek out ourselves. So, I think that we have to proceed with CAT in a way that's comprehensive. You can't proceed with this three-legged stool. You have to have all of the components in it. If we could rewrite the whole script and not do CAT and let the private sector solve the problem, maybe that would have been a better way to go, but it's not on the table.
Well, you also have elements like the OTC market that Jeromee talked about, and integrating data from that, which is a dark market, and then you've got swaps markets and all, and you could even throw bond market data in there. At
the end of the day, the idea behind CAT, again, a very good idea with a lot of different consequences. Gathering the data is difficult, but it's not the hardest part. Doing the analysis on the data is the hardest part. So the idea of crowdsourcing knowledge to try to comb through that data, and then when you find problems, then you put experts on it, doesn't sound like a horrible idea at all. I mean, that's what, when they were looking for Steve Fawcett, that's what they did, right? It can work. I don't know. I haven't really thought about what unintended consequences that could have, how we make it anonymous, how we don't let certain information out that creates the wrong, that creates any kind of bad behavior. But certainly it sounds like a great way to do it. Many academics would love to have that data and go through it.
You're going to be real. Anytime you put that data out there, you're going to be real careful. Yeah. All of a sudden, you get account numbers and Social Security numbers out there.
That's what I mean.
That's part of the
how do we
make
it anonymous?
I think your other point, though, between we have two different regulatory regimes on the future side and the security side. And we know from past history, I don't know how many years Ed and CBOE fought to get certain products to market. Those two different regulatory regimes, while they tend to cooperate and sometimes play nice, when you have that bifurcated paradigm, it's tough. It's tough to get them to work together.
We have different standards for linked markets. Any equity-linked future, why are they not regulated by the SEC?
Well, consolidation of regulation is a battle that's been fought for a long time. There's a lot of vested interest in Washington. I don't know that that'll ever happen, but every other country looking this direction scratches their head as to why it's as bifurcated as it is. And that's the ideal situation, Shelly, as we all know, but I don't know that it's going to happen very soon. So we have to deal with it as it is. And going back to the point that I was making earlier, if we're going to have something that is going to purport to help surveil the collective market, all the information's got to be there. And Ed's right. There's a lot of, as proposed, personally identifiable information in that database, John, and you're not sending that out to the...
No, I agree.
Right.
I agree. It certainly can be standardized in a way that doesn't include that, but still is somewhat unique.
Yep. Or you can just shop at Target and your information's out there, and it's easy to.
Nice.
So somebody mentioned the gorilla in the room, and I think they got it wrong because we've talked about the gorilla in the room as the OCC capitalization plan. So who wants to talk about the OCC capitalization plan? Who has a strong opinion about the recapitalization plan that they really want to share? Get it off their chest. Anybody?
I've got an opinion on it.
I was waiting.
You can go first. I think we've been out there very, very publicly about it, and don't find fault with the need for the OCC to raise additional capital, but think it's very, very tricky when you take something that is a monopoly and have the potential to monetize it, and where is that as far as a cost to the industry and the process in which that structure was put in place, and the potential unintended consequences down the road, whether it's from a competitive standpoint and the impact to some of the folks up here, or the longer-term impact, some of the costs to the folks out there.
So let's be clear. It's not a monopoly. It would have to be some kind of oligopoly, right?
Well, where the OCC sits in the OCC spot today, there's no competitor to the OCC as far as clearing.
But the owners of the OCC.
Yeah, but you can have multiple owners but still have a monopoly, right?
Yeah.
So it is a monopoly, and it's they have got a legal and regulatory obligation to operate that clearing agency without putting undue burden on the participants. And at the end of the day, the capital plan certainly puts an undue burden on competition by redistributing the fees charged participants to select owner exchanges as they go forward.
So my question to you guys is, who's got the courage to come forward and to say, let's do something together as an industry before the regulators force us to do something? They've already, Ed, they already forced the CBOE Clearing Corporation to become the option clearing corporation, right? We've already been, created the monopoly for this. So is there enough fear of what the regulators could do to say, hey, let's come up with a commercial deal, let's open this up, take some of the issues out of this?
Is Craig here?
Listen, it's before the SEC. It's a tough one for any of us to comment on, at least it is for me, because as an equity stakeholder, the matter is before the SEC. Listen, the OCC board, a lot of bright people on there, mixture of equity owners and member firms, came up with a plan that served its primary purpose, which was to provide the funding in a timely manner. And the industry is debating, and it's being considered before the SEC whether that's the appropriate plan or there's a better plan. I don't know where it's going to come out. My guess is in the short run that will be the plan, and maybe through some kind of evolutionary process, the structure of the OCC may change. As was pointed out, it used to be the CBOE Clearing Corporation. We weren't so thrilled. They have to give up half of it, and then we were a third. Now we're 20%, ironically. But I think that it will end up in a good place. I think in the short run, given the timing pressure that the OCC was under, they needed to get capitalized, and this serves the primary purpose, which is that. And I think the very valid points that other competitors are making will be considered, and ultimately it may evolve to something that is satisfactory to everyone.
I mean, the founding exchanges put up capital many years ago.
Yeah.
You can argue whether or not $1 million to join then was significant or not, but it's a fact. And there was a process that the board went through, the pressure that they got from the SEC and from the government of not being capitalized, a process that went through the board, was vetted, and like Ed said, I mean, there's people at the table there that are represented at the clearing firms and exchanges and independents, and this is the way it came out.
I think the important thing is, and Jeromee said this actually at the start, we can all agree, and I think everyone in this room and in the industry and beyond can agree that having a properly capitalized central clearing firm, a clearinghouse at the center of the options industry is absolutely critical. And so the question is, how do we do that? How do we ensure that it's sustainable going forward? And how do we ensure that it's in line with the rapidly emerging regulatory standards that are going to apply to the OCC, given its recently declared status as a systemically important financial market utility, in line with the very fast approaching expected compliance date. And so, as Ed said, it's before the SEC. A decision will be made. The current plan was recommended by the board, which constitutes a broad array of industry constituents. It's not just the owner exchanges, it's broker-dealers and clearing members and retail firms, and it remains to be seen how it's all going to shake out.
And it's fair to reiterate that, right? The OCC as a SIFMU, right? It was designated as that for the right reasons, right? That it is a critically functioning and important part of the industry that provides a lot of benefits to everybody up here and everybody out there. The fact that we have that central counterparty that guarantees all those trades, we wouldn't have the same market that we have if they weren't in that role. And so keeping them well capitalized is something that we can all agree on. How we end up there, we'll see.
And it's got a lot to do with everything you guys both mentioned. Of course, we all agree it needs to happen. It's the process in which it did happen. And yes, it was done by the board, but there's a lot of controversy around that. There hasn't been any transparency put into it. Tom mentioned that the owner exchanges, yes, they bought into it in the beginning, and regardless of what the capital was buying into it, they're entitled to their ownership. But that doesn't answer the question that the non-owner exchanges were not even given the opportunity to buy into it, so they weren't allowed to buy into it. Again, understanding Ed's point as well, we went from owning 100% to 20%, but at the end of the day, the fact of the matter is it's a monopoly that operates and has a large group of participants, and it's not just the exchanges we're arguing this for, as from a competitive standpoint, it's all the users of it as well. This is a tax on the users. The users are going to be paying this fee that will be transferred back to the owner exchanges. It's monetizing OCC. And the question is it monetizing it fairly? That's the big question.
I haven't thought this through, so I probably shouldn't even say it. But I mean, exchanges used to be utilities, right? Member-owned utilities.
Yep.
I mean, the Philly Exchange was.
But they're not monopolies.
But they weren't monopolies.
Yeah, but I would argue that OCC, I mean, is it really monopolistic? I mean, it's
OCC is not a monopoly.
What choice do you have?
What's a better definition of monopoly?
We're going to start another one.
Is that news?
But even if you look at the pricing has been favorable. I mean, it's not.
And it should continue to be favorable.
And there's nothing stopping the OCC from demutualizing as well, right? The OCC could turn around and go public and be a for-profit entity in and of itself. That could happen.
Exchanges were pseudo-monopolies, too, with their proprietary products. I'm just saying, it's not, we were a utility. We were member-owned. We transitioned. I'm not saying that's, the same thing as the OCC, but I just think, honestly, if you were sitting here like you were 5 years ago, you'd be saying something different.
And you might be saying something different if you sat here, so we won't go down that road.
We all view everything from the seat we sit in, right? There's no question about it. Bottom line is the capital situation is the first and foremost issue that had to be addressed. It's being addressed. I suspect a year from now we'll be looking at this thing and finding it not to be the controversy of the day. It just happens to be today.
So on the other side of the coin, we have BATS that has an exalted position, and NASDAQ and NYSE find themselves on the short end of the stick, and that's the SEC market structure panel, where there's no listing exchanges represented, where there's a there's no retail brokers represented on this market structure panel to look at equities. How are we getting these things so wrong?
You know, John, it's symbolic in a bit of the history of the options market, and when there is a securities industry group put together, it is, and rightly so to some degree, always equity-centric, but where there's little to no representation by the options industry, I think it's a little bit of, oops, we forgot that that's a significant component. There's no question the structure of the equities markets and how things could change coming out of that group can and would have a significant impact on how the options markets operate. They're on trade through protection, and cross and lock markets are limiting their agenda items, and we've debated internally with our advisory group our views on that issue and how we would feel as CBOE about potential changes in the equities markets and, for example, allowing trade-throughs, and how would that impact us. We are derivatives of the equities markets, and everything that happens in the equities markets impacts us. We are in need of a very healthy, well-functioning equities markets, and there may be a reason to change some of those things. But we need, as an industry, to have input. So some of the exchanges here who have healthy equities arms are involved by virtue of the fact that they're in the stock business. We made a run at that. We're not in the stock business. So our ability to influence is through comment letters, but we don't have a seat at the table. And I don't think the industry, options industry as a whole, is sufficiently represented.
And I
Quite
think
frankly,
actually,
it isn't represented at all.
Yeah, the issue is actually, I think, from NASDAQ's view, my view is it's much bigger because we don't have a seat at the table. NYSE and NASDAQ don't have a seat at the table. We're listing venues. We have listed companies. And we think that one of the two should have been there to represent that fact. And going back to 2008, I agree with you. I'm sensitive to the option side of it. And when there was restrictions against short selling, it was never the options market making. Back to market making again. That was never considered. So I agree. And at least whatever I can do when I'm down there, I can bring that side of the argument to the table. After the committee was picked, we did call down and told them we were displeased about not having a seat at the table, as well as retail representation. And now we are invited next Wednesday. Tom Farley and myself are invited to go down and testify on Rule 611, which will have implications to the options market based on how we frame that. But yeah, I don't understand how that committee. Maybe I guess they thought since Eric Knoll worked at NASDAQ and Joe McCain worked at New York that they had that.
Well, and just to be honored that Bats got the ask, I'm going to speak for Joe Ratterman and say that the fact that he was asked to be the part of it, that feels good, and we're happy that we got a seat there. But we didn't go in and say, and by the way, please exclude our competitors, right? That wasn't how the process worked.
Well, yes, I will agree with Tom that former NASDAQ and NYSE executives are well represented.
Yes, they are
on the body. No, I mean, first of all, I don't envy the SEC having to put something like this together. It's one of these things. I was making a joke to someone about a related issue the other day. Which is making decisions to allocate specialist rights, and somehow there's always one good phone call and 9 bad phone calls after you do that. Similarly with the no matter who was going to be on the committee, if it was any reasonable size, there were going to be some parties who felt disenfranchised and disappointed. I'll say broadly, while I agree with all the points that Tom made, certainly particularly with respect to the inclusion of a stronger voice from the options community, our exchanges, our markets in the world of options are directly and strongly impacted by decisions made about equity market structure. The short sale restrictions, which did not include an exemption for options market makers, is the best example of that. That was a hugely impactful decision. But I mean, broadly, we're comfortable as the New York Stock Exchange, and as Tom alluded to, we have participation on the panel, and we're comfortable that we're included in the critical decisions the SEC is making about equity market structure. That said, the issue is bigger than the exclusion of greater representation of options. Some of the other parties, as Tom mentioned, not only retail but also public companies, U.S. banks. There are a lot of broad constituents in the equities market that are not directly represented by the members of that panel, and as an entity with a strong equity exchange and listing exchange business, we think not just having equities exchange represented, but having listing exchanges representing public companies be part of that process is really important. So our hope and our expectation is that as the SEC manages the process, they'll continue to reach out to other constituents and bring them into the conversation.
Yeah, I think everybody that's participating in that recognizes that there is a lack of representation on the retail side. So I know, again, I speak for Joe, I know Jamil also, they are working out and actively engaging and speaking to that retail community. We're not the only ones. He's not the only ones. Folks are working to make sure that voice is heard.
So Ed Boyle, you've been in this seat over here before the San Antonio event. I remember getting a really nice pair of cowboy boots at that event. We've had some changes in OIC and how it's funding this year. I didn't even get like a pair of flip-flops.
What are boots?
What does the change in the funding structure for OIC mean, other than my footwear?
And how does that impact your choice of footwear?
Well, the reason I'm not wearing my boots is because I had to fill Tony's shoes and he didn't have any boots in his closet. This is what I got stuck with. The funding for OIC, and this is really the path we've been going down, is as you said earlier, you argue what the seats you're sitting in, and fairness is something, though, that I think the industry really has to continuously think about. And it's always difficult when you're representing your shareholders or the interest of the corporation you work for. But at the same time, we have to think about what's healthy for the industry and how that's going to move forward. And I think that should be the key piece of how it's viewed, no matter which seat you sit in. And that's my, that's really, I'm not going to go down the path and say any more than we've already said and just kind of continue to beat that. But I think that's really how we should be looking at it.
Well, just so the audience knows, the funding of OCC used to be based upon a contribution by the OCC and then a contribution by the exchanges based upon their share of the market.
Yes.
Correct. And again, I'm not sure how many people know that has changed. It's in a bit of a transition period, but now the OCC is continuing to fund the vast majority of the OIC, which is the industry utility for providing education on options. And then the exchanges are morphing to an equal contribution of, I think, $100,000.
Based on exchange group. Yes.
Right. So which versus the OCC's $5+ million contribution is rather small. But I mean, to Ed's point, I think the effort was to get away from you contribute based upon your competitive position to simply we all contribute a number, and the OCC, who through its OIC, which runs those programs, is the main provider of funding.
And we all very much enjoy the benefits of the OIC. Yeah. And I don't think where they landed was a bad spot as far as what the formula is. We all enjoy equally that educational arm. Very few of us have huge educational initiatives of themselves, right? I don't fund outreach out there, going out there trying directly to grow the options businesses with BATS, trading options 101.
Let's make no mistake, my efforts are on our proprietary product. It's not on the generic product. But the one thing we didn't talk about, John, and I hope I'm not front-running you, but the education that this industry puts forth to both institutional and retail investors is critical. We know the market is slow now because of market conditions, but we are continuing as an industry to grow the base of users at the institutional and retail level. The retail brokerage firms that are so active in this business really don't need our help in doing that. They do a fabulous job themselves. But at the institutional level, there is tremendous untapped potential in the pension, endowment, family wealth office areas. We find that there is great potential for us to continue to grow our collective products because there's still a substantial underuse of the product.
Okay. How do you feel about the fact that you have exchanges that are not offering as much education to the industry as perhaps you are now for your proprietary products, but that still has an overflow for the rest? I mean, does that I think
OIC has been a fabulous solution. So OIC was created how many years back, guys? Many years back, and it provided for the marketing of the generic options product, collectively supported by the industry, well administered by the OIC, and our Options Institute, which is a fabulous organization and was very broadly focused on options, narrowed its focus substantially to the products that are near and dear to our hearts. And so I think the industry is being very well served.
Okay.
And other ancillary benefits to that. I mean, you think about this conference itself. I think this was something that you drove a number of years ago, where it used to be the exchanges directly organizing, funding, sponsoring this conference. Now the OIC plays a much bigger role. That makes it much easier. Credit to Don and Jen and everybody involved in putting this together for a small exchange to be able to offer very much the same experience that a big exchange can put together. That's part of what the OIC does.
It keeps the quality of the conference at a level that's acceptable.
And there are other important aspects of that outreach as well, besides what OIC is doing, and I certainly agree with that. OIC is a great utility solution to the question of how do we, as an industry, fund educational efforts that benefit all of us. But it goes beyond that as well. A number of exchanges Tom's done independent events with OIC targeting to groups in New York and elsewhere in the institutional community, where we'll bring in trillions of dollars worth of AUM into the boardroom at the NYSE and talk about the benefits of the options product. To give CBOE a plug, they funded a terrific study, I believe, which talked about the outperformance both in return, but more importantly in terms of risk reduction of funds that invest in ETFs and mutual funds that invest in option strategies, which is a really important result, is for us to continue to go out there and put the data together. We represent collectively as an industry just a terrific product. I mean, the benefits to investors of just basic option strategies, the protected put, the covered call, the collar, and enhancing portfolio returns in an environment where, as there was some discussion yesterday during the panel, everyone's out there chasing yield. Yields are really tight out there around the world. We're looking at negative interest rates in Europe. What a great way to enhance a portfolio return by doing a covered call, judiciously. So putting the data together that continues to demonstrate that you can enhance returns, you can reduce drawdowns and reduce the standard deviations of portfolio performance by incorporating an option strategy into an institutional portfolio, particularly given Ed's point that there's still a lot of room for increased adoption in the institutional community, is really, really important and something we should all continue to push aggressively.
All right, I want to talk about something out of left field a little bit.
Oh, boy.
There we go.
One of the things that we've seen a paradigm shift for in the financial markets is the interest in digital currencies and the interest in the blockchain technology. There's a number of the exchanges that have invested in some companies. Goldman Sachs just made a big investment. Don Wilson has got a very interesting operation and just hired Blythe Masters as part of that. And so, they're looking at this technology and how it can be used in the space. And one of the fascinating things to me is when you look at, say, Bitcoin, and you think of it as a vault. Okay, so for $300 or whatever the cost of Bitcoin, you have a vault. But you can take that vault and you can break it into 100 million pieces. And now you have 100 million vaults. And so the cost of the $300 is nothing compared to the value of having 100 million vaults where you can throw derivatives positions or equity, stock positions or whatever. Does this have the possibility of revolutionizing the trading industry, the way that clearing works, the way that products are packaged and structured?
I think where the real value in it's going to be is in clearing and settlement, because at the end of the day, that's what it is, right? You've got this very secure, very digital way to move ownership of anything. It could be the title of a car or a position into and very safely across any space. So it's much easier than the current structure we've got. I don't know that digital currency, Bitcoin and things like that, play much of a role, other than possibly there could be some indexes or something created on it. But it really is the underlying technology. Disruptive technologies are always about the underlying technology. kind of think of cell phones in their early days. We all remember, they were, not all of us, but they were called car phones because they were in cars and you only spoke on them. Suddenly people saw it was the network and the hardware software infrastructure that created smartphones that we all now use heavily. So I think that that's the real piece, and I think clearing and settlement is where the real benefits may or competition may come from.
Steve, you guys made an investment.
Yeah, we thought it was an interesting time to make. So we made a small minority investment in Coinbase, which is a Bitcoin wallet company, and we see opportunities in a number of areas. The distribution that the New York Stock Exchange can bring in terms of dissemination of data. Are the appropriate reference prices and benchmarks in place right now in the Bitcoin transaction community? What sort of technology can we bring from that world into, as Ed said, the world of clearance and settlement? I mean, what's really interesting about the blockchain technology is this notion of publicly verifiable transactions. Anybody can look at the blockchain, and there's sort of this verification that builds over time as more entries are added to the chain. It can be very difficult to manipulate or submit or report fraudulent transactions if the technology is used properly and managed as it's designed to be built. So there are some strategic opportunities there that we're looking at, and we'll continue to do so. But it's a new technology, it's emerging, and we're interested to see how it all plays out.
And it goes both ways, right? So often we're looking at how can we take what we do very well and expand into additional assets and additional geographies. Flip side to your point, how do we take those new technologies that are out there and bring them into our world?
So there's a criticism of the exchange space that they don't think out of the box enough or get outside of their sweet spot of whatever. That you're really in the business of transactions and then ultimately clearing those transactions through OCC. You got a company like Uber that comes out of nowhere and all of a sudden it's worth $30 billion and they process transactions. Are there some things that we're going to get into outside of the realm, or are we just so focused on our core business that we're missing all those opportunities?
Well, everybody wants the next great idea. I think from a new product development standpoint, speaking for CBOE, it's been at the core of what CBOE's been about for 42 years, and certainly this year we've brought up and announced a number of new products. Are they that far outside the box? Not really. But we are making investments in businesses, John, that are more an extension of our current business, not so disassociated with our core business that it doesn't make sense for us. To some degree, we all know what we know, and maybe we know what we also don't know. But our objective is to continue to grow our business through bringing up new products, variations sometimes of the current products, sometimes substantially different than what we've seen in the past. And we'll continue to do so. But what we look at in technology investment is things which will help extend the use of our products. We announced TradeLegs, a fabulous technology that provides an investment advisor the ability to input a portfolio, set investment objectives, and it generates the legs of the option strategy that investment advisor should put on, something that makes our collective products, because it's not unique to CBOE's proprietary products, more usable. So I think that's where the direction we're likely to head, more so than something completely different from what we've been involved with.
What are you guys excited about from new products that you're offering or that you've offered in the last year, Boris?
Well, I was actually going to point out, a couple of things that we've been working on for the last few years and making a lot of headway. We have a Longitude platform that's made a lot of headway in the gaming and wagering space, and that's a big business opportunity for us that's done outside of the options exchange business. And a little bit more adjacent, we have a group focused on the exchange-traded products side of things called ETF Ventures, where we partner with outside parties to launch indexes and ETFs. I mean, Jeromee mentioned during the exchange update yesterday, we've won some awards for some of our indexes, particularly the cybersecurity index that also has an ETF based on it. So those are definitely areas that are somewhat adjacent in some cases and not so much, that we are really focusing on right now and look forward to over the next few years and growing those businesses.
I have to from Bob's viewpoint, his analogy is trying to stay, bowling alley, pin left, pin right, and try to, stay in that kind of core, as you say. So we tend to stay there, looking at developing new indexes or ETFs. Pin right is us entering the option futures area with our Philadelphia Board of Trade license. Was announced in Boca a couple of months ago, where we'll compete for energy futures. So that's kind of, down our alley. We do like a Dorsey Wright acquisition, which doesn't seem to be left-right pin. So we do think outside the box with other, acquisitions to try to augment the overall business. It's not really option-oriented, but, the futures platform, what we're going to do there is something I think will be interesting.
I'm sorry, Tom. In addition to the VIX Weeklies, which Andy mentioned in his presentation, which we will be bringing up in July, we entered into an exclusive arrangement with the MSCI Group and have begun trading cash-settled options on the EFA and EEM indexes. We've also entered into an exclusive relationship with the London Stock Exchange Group, where we are now trading Russell exclusively, and we're bringing up FTSE options toward the end of the year. So they have a number of indexes which we think will further complement our growing array of global indexes for options and futures trading.
So we've also been very focused on one of the great benefits of the New York Stock Exchange combination with Intercontinental Exchange, ICE, is the opportunity to find synergies between the various pieces of intellectual property and technology on both sides of that former divide. And so one of the things we've done is we acquired a company called Super Derivatives. They have very interesting pricing, valuation, and reporting, charting, other similar functionality for looking at managing and assessing the risk of derivatives position. That's a very natural fit for the options trading community, and so we're looking at ways to take advantage of that. There's a technology platform called ICE Chat, which we're making available within the next couple of months for submitting orders electronically via clear text IM directly into our trading platform or matching engine, or to a floor broker workstation for execution and open outcry. And so that's something that we're really excited about. We're demonstrating it in our booth actually right now. But a lot of it, to Tom's point, is also about, and look, we can't just staying the course it's not just about inertia, because the landscape is changing, the technology requirements are evolving. We've announced our new trading platform, the New York Stock Exchange Pillar platform, to go live first on our ARCA equities market later this year, and to be followed shortly thereafter by the New York Stock Exchange and then our options platform. So we're excited about performance, stability, new feature benefits we're going to be able to bring to the market there. We're looking at relaunching on the MIAX platform the single stock binary options product that we traded some years ago, and making some announcements there about timing over the course of the summer. And also just with respect to evolving our core offering, something we haven't talked that much about in detail here today, but which applies to all the exchanges, is the increasing importance. It gets back to the very first topic we talked about from the standpoint of liquidity providers being comfortable to take risk and being on so many bids and offers, hundreds of thousands, almost 1 million now, quoted options in the market, is enhancing the risk control and other market maker protection technologies that exist out there, and also not for market makers. Pre-trade price validation, in line with SEC objectives and OCC stated cross-exchange benchmarks. We recently announced pre-trade price validations for market maker quotes, which are going to apply both during core trading and also, crucially, before the open. Because most of the system problems and trade issues that have happened in our industry happen first thing in the morning because somebody made a change overnight. So even to the extent that we are focused on the transactions business, there's a lot that has to happen across the board, I think, on all the platforms represented here in order to keep up with the shifting environment.
Okay. Any questions from the audience? We have a couple of people with microphones, I am told, somewhere out there. Anybody want to raise their hand and give a question to our esteemed
Where's Solito?
fan?
I heard he might have had a late night last night.
All right.
Oh, wait, we have one in the back, I think. No?
One in the back?
I saw a microphone in the air, but I can't really see much. Well, not.
It's like we're in a police line.
People just leaving early.
Yeah. Okay. Well, I wanted to thank the panel here today. You guys did a great job for a very long panel. We're going to end a little bit early. This was the longest panel that I ever did. I did a panel one time, and we had 15 members on the panel, and I had 45 minutes. Tom, you were on that panel, and it was like speed dating. So I really appreciate the depth to which you guys got into to some of the questions here. Certainly, there's key issues that are facing us in terms of market structure, in terms of the OCC, and just the general environment. The education issue, I think, is really important and something that we're personally, or my company personally, is trying to focus on because I think we've lost an entire generation of traders through the scandals and the market crashes and everything else. And so we've got a lot of work to do to bring that back. One last thing relative to that, the trading floor has been a great educational and tourist attraction platform for us for many years. What are we going to do as an industry to attract people to these markets without showing them the flash of the trading floors?
Well, the trading floor, in particular in Chicago, but I guess New York as well, has been so symbolic of the vibrancy of our industry, futures and options, and certainly the fading of the open outcry trading environment is kind of sad. When I bring people down to our floor, I bring them down on the side where the SPX and VIX pit is, because the rest is just a bunch of angle iron, truthfully. But, with social media, electronic media, the way things have transitioned over the years in terms of communication, I think we can project our message out. I know we're engaged with a lot of different colleges and universities, John, to bring the concept of options trading and derivatives to them so that people come out of business school with some knowledge basis of what's going on in our business. So we're communicating in ways very different than we used to in the past. So the absence of the trading floor is sad, but I think it's being replaced by things that are more efficient.
It's bringing a different type of person into the business. The markets we all grew up in together, in the trading floor, it was more feel, seat of the pants, look a guy in the eye. It was a different environment. It was a different level of trust. In the markets today, the way we're evolving, it's much more obviously computer science and mathematically oriented, and it's a different breed of trader coming into the market today than when we got our start.
That's very true. We're teaming up with MIT and bringing some young blood on the development side. So you show them data and patterns and the Carteret Data Center or the NASDAQ market site, but it's very computer science oriented, very math oriented, very quant oriented, and it is a completely different game.
I wouldn't have made it today.
Yeah, I would certainly agree with the emerging importance of technology and bringing a different type of person into the market than may have been attracted some time ago by the buzz and excitement on the floor. At the same time, we certainly remain very dedicated to our trading floor business. I think somewhat uniquely, we just renovated our options trading floor, moved it into new space built from the ground up to facilitate open outcry executions and options, which continues to be an important part of our business and is not a part of our business, contrary to popular belief, that's been shrinking. If you look at open outcry volumes on our two trading floors over the last, probably 5 years, it's basically exactly what it was. So we continue to remain focused on that business, while at the same time, obviously, ensuring that we're positioned for the continuing growth, we hope, after a little lull here of electronic trading and options.
I think the sentiment over the last few years, I'm sorry.
No, go ahead, please.
And you mentioned it, scandals, hiccups, regulation, all of the things in the media. I think despite all of that, and also from a perspective of a global parent company, I think the U.S. market is still by far the most retail market in the world in terms of participation directly through discount brokers, or at least among the most retail-friendly markets in the world. And I think that we just all have to do a better job of sort of regaining some of that confidence and the sentiment. And I think you're right. Maybe we have lost a generation or a segment of the market through the financial crisis, but also through things like the flash crash and other incidents and all of the news and everything that kind of seems to hit every few months. And I think that Reg SCI, other regulations, I think everybody doing a better job together, regaining that confidence, coming back up in terms of the esteem that we command, the respect that we can somehow regain from the general public, I think that's what will keep the market growing and retail participation, because that's ultimately what every segment of the market needs and wants. It's continued and growing retail participation.
All right, we're going to end there. Thank you very much. Thank you for
thank you, John,
for listening in.
All good.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.